In a criminal investigation, the police will generally first identify potential suspects. The suspects are then subsequently dropped off the list through a process of elimination, with the police only focusing on those who can be directly connected to the crime. Similarly, analytical procedures enable the auditor to identify items that warrant further investigation. Analytical procedures refer to the analysis and investigation of the relationship between related account balances, transactions, or metrics. These procedures are useful in identifying unexpected differences, potential errors, unusual transactions, and potential frauds. The result of analytical procedures may either indicate that the amounts are reasonable or that there are unexpected differences that are significant and require further investigation. ISA 250 on analytical procedures states that the auditor shall investigate inconsistent results by inquiring of management and obtaining appropriate audit evidence relevant to management's responses, and performing other audit procedures as necessary in the circumstances. Let's now look at the inventory turnover ratio, an analytical procedure that assesses the relationship between cost of goods sold and inventory. Inventory would normally be reduced and cost of goods sold increased whenever a sales transaction occurs. The formula is as below. Inventory turnover is equals to cost of goods sold divided by average inventory. So how can this ratio be used to highlight fraudulent activity? Jack Mills is the accountant at Beanstocks Proprietary Limited. Jill Nix, the auditor of Beanstocks, has performed analytical procedures over inventory turnover as follows. The inventory turnover for years 20X7, 20X8, and 20X9 is 6.88, 6.92, and 9.87 respectively. It can be noted that the inventory turnover in the years 20X7, 20X8 is fairly consistent, but this ratio increases by 42% in the current year. Jill has determined that this increase is significant and warrants further investigation. To investigate the anomaly, Jill compares the sales to cost of sales as indicated below. She discovers that there has been a significant unexpected deterioration in the gross margin in the current year compared to the prior years. Upon further investigation, Jill discovers that the fraud relating to the theft of inventory was being perpetrated by Jack in collusion with the store manager. This inventory was then sold to external parties. This was the reason why the cost of sales was increasing, but there was no corresponding sales transaction. To recap, analytical procedures are useful in identifying items that appear to be reasonably stated and do not require further audit work, and those that have unexpected differences or anomalies and may require further investigation. It should also be noted that unexpected differences do not necessarily mean that an error or fraud has occurred. Such anomalies, therefore, need to be further investigated to assess whether a material misstatement exists.